Hello and welcome to the Psychology of Trading. My name's Steve Ward and it's great to be here on behalf of XTB to spend the next 60 minutes with you talking about the psychology of trading and the role of the mindset in our decision making and our risk taking when we're engaging in the markets, and to cover some of the sort of the core basic themes of that topic, and along the way to hopefully give you a few practical tools and techniques as well. Just a brief introduction to myself. So my name's Steve Ward. I'm a trader performance coach. I've been working with traders now for just over 16 years. Started in February 2005 on the day of non-farm payrolls. And that was with a large prop trading group in London, about 250 traders. And then really from there, I spent a long time working in that prop group for about 3 days a week for about a year or so. And then went on and have done since then to work with banks, hedge funds, asset managers, commodities trading houses, energy companies, utilities companies, proprietary trading groups, and really everybody who's involved in trading the markets in some form or other. And some of those clients and the traders I work with are beginner traders, kind of at the very early stages of their career, and then all the way through to traders, probably the very, very, very top of the trading game. Over that 16 years, thousands of different traders across multiple different asset classes, trading the markets in a very wide and different variety of ways, as you can imagine, in over 150 different trading and investing institutions. And as a part of my work each year, I try and do some work for the retail trading community, for the private traders and investors, like many of you will be. And that's why it's great also with XTB to get the chance to have this session today as a part of that. I've also over the years written a number of books, as you can see on the screen there. And at one point, I actually co-managed a team of 45 proprietary traders in a trading group in London. And not so much now, but certainly a few years back, I was an active trader myself, trading mainly FX and stock indices. So I want to start really by getting you just to think a little bit about your own trading and just be thinking, is this like me? So when you read through the statements on the screen, just maybe be thinking about, is this something I do often? Is it something I do sometimes? Or is it something that I never do? And just sort of working through the checklist, just reflecting on your own trading as you do so. And I'm sure many of you will be ticking one, two, several, possibly maybe even all of those boxes if we think about whether we might do that sometimes. And I just want to put this on here because I've had the luxury of working with, as I said, thousands of traders all across the world. And I can share with you now, based on that experience, that if you've ticked any of those boxes, you are not alone. So there'll be many other traders having exactly the same challenges. The nature of the challenge and maybe the size in terms of the amounts of money at stake, and also sometimes the reasons behind why the behavior is showing up, can be quite different. But there's a commonality amongst traders which results in these behaviors. And that commonality has two components. One is the fact that we're all human. And so we are subject to the human condition and the challenges that sometimes arise from being human. And as humans, we are, as traders, also making decisions and we're taking risk under conditions of uncertainty. And our brain is simply not wired to make good decisions under conditions of uncertainty. So when we put all that together, put in these, take these humans, us, put them into conditions of uncertainty and ask them to make decisions that are risk-based, then it presents a whole number of challenges that arise. And of course, the frequency of the challenge and the magnitude, the size of the consequences of these challenges is a variable and perhaps some of the nuanced reasons as to why they occur, but you are definitely not alone. And so what we want to have what I want to do today is to share with you really some ideas and thoughts about how we can reduce these events happening or reduce the magnitude and the frequency of them. Very difficult, I think, if you have a mindset where you're going to say to yourself, I want to get to the point where I don't make any of these mistakes. And I do come across people who have that mentality, and it's not helpful because we're human and we're fallible. We do make mistakes. And I think it's really important. And George Soros talked about this at one point, just recognizing the fallibility of being human. And that's really important, actually, when it comes to making decisions and to trading, as we acknowledge that, we will get things wrong. And then we can deal with them and recover from them as effectively as possible. So one thing we can be thinking about, and you can think about for yourself in your own trading, is this behavior gap. And the behavior gap essentially is, if you think about the returns you're getting from your trading, so the money you're making or losing at the moment, your P&L, and then think about how close is that to what I think I'm capable of making. And probably for many of you, there'll be a gap, and that gap might be quite small. You might be making quite close to what you think your strategy should be returning for you. But for other people, that gap will be quite wide, and you'll get the sense that actually, you might be leaving lots of money on the table, or you're running your losses much too far. Emotions might be getting in the way for you, overconfidence, over trading, a whole variety of factors might be creating this gap. One way that we might frame this is this gap between knowing and doing. So many traders will be clear about what they should be doing in any given moment, and yet they might find themselves not doing what they know they should be doing. And you might be able to think for yourself of some situations where, I knew I should have got out the trade at this point, or I knew I should have stayed in the trade, and yet when I reflect back, for some reason, I didn't do what I said I was going to do. And there can be a variety of reasons why that might happen. But there is, for many people, this gap between the knowing and the doing. Now, it's important to stress, when we think about trading performance, we do need to know what we need to know. So before we really get into the psychology of trading, quite often when I've worked with clients, maybe more so in the retail sector, I do get people who come to me and they feel they have a psychological challenge. And then when we sort of talk and we discuss and we look at what's really going on for them, we often find that actually there isn't a psychological challenge or problem, but they're having a psychological reaction as such to often what might be a knowledge or a skills gap, or a lack of a well-formed strategy. So it's important to know what you need to know. So there will be obviously some relevant skills for you, depending on what you're trading and how you're trading it. There will be knowledge that's relevant. And you will need to have some kind of strategy, a way that you put your skills and your knowledge together, and then you engage with the markets. So you need to have that. So that's like the platform. But once you've got some skills and you've got some knowledge and you've got your strategy, which I would kind of put into the domain of kind of competence. So once you know what you are doing and you know what you should be doing, then it's interesting in terms of looking at, well, is there this gap? And certainly for many of the clients who come to me from institutions, there is a gap, or they feel that they could be, pushing those kind of lines up higher. So then the doing piece really becomes much more about the psychology. So the reasons why we don't do what we know we should do can be down to our psychology, actually also down to our physiology, what's going on in the body. And we'll touch on that a little bit later today as well. But just have a little think to yourself, what's your gap like? How frequently do you find yourself maybe saying, I knew I should have done that, but actually not doing it? And if that's the case for you, also just think about, are there specific situations when that is arising? Because there might be some times when you know what to do and you actually do what you know you should do. And there might be other times when you know what to do, but you're not doing what you know. So it's quite important to recognize and be clear about those differences. So I want to run through a number of kind of themes and topics. And again, we haven't got the luxury of great amounts of time. So I'm going to go for give you a broad range rather than going into one topic in a narrow way, but we'll save some time at the end for Q&A, and we can always drill down a bit deeper if that's useful. But I just want to talk first of all about what I would say is like this kind of pervasive overriding mindset that I find in many of the best traders that I've worked with. And a good example of this was about 10 years ago now, 2010, 2011. I was asked to go and do some work for an investment bank. And we were putting together a program for traders to have performance coaching. And it may sound strange, but even in 2010, that was a very unique and a very novel thing to be doing. It wasn't widespread in the markets that traders would have performance and psychology coaching. So we were putting together a pilot program for them. And there was we did a presentation, and then the traders had a chance to opt into the program. Now, something very interesting happened. The first point of interest was that the lowest performing trader in that group did not ask to come on the program, and he was the only one that didn't. So that was quite interesting. The other interesting factor is that the highest performing trader, who was the best trader by quite some way, and was actually seen as being one of the best traders the bank's ever had, still relatively young, but very high performing, insisted that he was in on the program. And when we then did the coaching, I asked him, I said, look, it's really interesting for me because I hear from your head of desk, from your manager, that you insisted that you came on the program and that also you were very keen to be involved. And I'm just curious to find out why that might be. And his response was along the lines of, look, it's X number of sessions, I'm giving up X number of hours of my time. And if I can get just one idea or one tool or one technique that helps me in some way to be a better trader, then that's great use of my time. And what that really highlighted for me was within him this kind of openness to learning and improving and looking for opportunities to get better, not just in terms of trading skill and trading knowledge and developing trading strategies, but also looking broadly, in this case, trading psychology. And along the years, I've been lucky to work with some phenomenally successful traders, including a few people from the Market Wizards books. And I see that same mindset in all of them. Now, before trading, I worked in sports psychology, and I saw the same kind of what we call the mastery mindset, this desire to learn and improve in the best athletes I worked with as well. I also did a bit of work in professional poker. Guess what? I saw the same thing in the best poker players I work with. So in these high performers, in these high performance domains, this mastery mindset built really around learning and wanting to improve is fundamental. And I'd really encourage you to be thinking about that mindset for yourself. And along with that learning comes this willingness to challenge yourself, to take on, try things out, do new things, and to experiment. And I think actually a lot of becoming a better trader is about lots of experimenting, trying things out, testing, getting the feedback. But it requires this, Carol Dweck calls it a growth mindset, because it's about a combination of, being willing to test and experiment and try things out, and also to be okay with it if it doesn't work out, because it's all part of the learning experience. So you're kind of having the lenses of seeing your trading as a learning experience is really powerful. Now, what's interesting, particularly psychologically, is when I talk to a lot of traders, particularly probably the newer traders, maybe beginners, novices, perhaps into intermediates, the danger can be when people start off trading is they come into it with a focus on making money. So what I would call an earning focus. And what that does is the tensions and the strains that come from trying to make money actually interfere with the learning process, and it hinders their learning. So if you're newer to the markets, my advice would definitely be for you, but true for all people, but definitely for those of you newer, is to really think about parking the expectations or any goals you've got around, making money from the markets to one side, and just really think about, what do I need to do to actively engage, to learn about the markets, to become a better trader around, skills, knowledge, strategy, and also maybe the psychology. I want you to think about this. How much luck do you think is involved in your trading results? So when you get a result from a trade, a win or a loss, how much role do you think luck plays in that? And this is an interesting question again, because some people believe that, it's really, it's all down to skill. And the research and evidence suggests actually that's not the case. Actually, what we have is this skill plus luck gives us our trading outcome. So skill plus luck equals outcome. That's the reality. Now, how much role does luck play? Probably bigger than most people might think, but probably less so if you're an experienced trader and you've honed your craft over a long period of time, and probably quite a large percentage of the piece if you're a newer trader. So experience and training and practice, exposure to the markets probably increases your skill over time and reduces the role of luck. But that luck's always playing some piece in your outcome. And that's important to acknowledge, that there is an element of luck. But what it means in terms of our psychology is we have to acknowledge that the markets are uncertain, there's uncontrollability, and there's novelty. There's also, of course, volatility and ambiguity. So there's a very complex environment you're making decisions in, and it actually becomes a probabilistic activity. Now, when activities are probabilistic, when there is luck involved in the outcome, then what it means is that the process that you go through becomes increasingly important. So the process is, the steps that I take to really stack the odds of success in my favor. And this is really the skill piece of trading. If we think about that skill plus luck equals outcome, we could replace the word skill with process and have process plus luck equals outcome. And of course, you can't control the luck piece, and the outcome is the outcome. So where do we have controllability? What can we get better at? We can get better at process, which has 4 key stages. So the first part of preparation is the first part of the process is how you prepare for the markets. The second stage is then the execution of the trading strategy. Then we have evaluation, so reviewing the trades that you've made. And then ideally from there, we go into improving and enhancing. So they're kind of the 4 big chunks of trading process. And it's really important that you spend time, getting the most robust process possible. And it is really about, doing everything you possibly can that increases the chances of success in the long term. So there's some nice questions to be thinking about, sort of reflective questions on here. And this is from Brett Steenbarger's blog, which is a great place to take a look for information on trading psychology. But it's really just this reflection around, what am I doing to make sure that when I turn up for the markets, I'm fully prepared technically and tactically, but also psychologically. What is my process for executing my trades? Am I evaluating my trades? And if not, definitely that's something you should be doing. A trading journal of some form is critical to becoming a better trader and for self-reflection and for self-improvement. And then importantly, how do I take the insights from my evaluation process and turn them into concrete goals and action? So I often used to say to the new traders when I was working around on the trading floor, what are you working on? And I'd expect every new trader, in fact, I expect every trader really, to be working on something. Now for newer traders, it could be developing some basic skills and knowledge. For traders at the intermediate level, it might be, they're trying to individualize their trading and, try experiment with different strategies to kind of find the ones that work best for them. For a more advanced trader, maybe they're working on the nuances of their trading psychology or even their physiology. There's always something you can be working on, refining or testing. Now, there's 3 key additions, I think, to thinking about this trading process. So you want to be building this process, your way of doing things. And what we ideally want is some kind of edge. And that's the idea of we're stacking the odds of success in our favor. So that over time, we feel that if we keep repeating the process, over time, that the strategy makes money. So we want to have that sense of some kind of edge or advantage. It's also really important to think about clarity. I've worked with a number of traders in the last 2 or 3 years who've had execution challenges, and part of that's been around clarity. So they've overcomplicated the trading process, and it's made it very difficult to work out when to get in and when to get out. And it's very complex, and it looks great on paper, but actually you can't execute it. So it's kind of finding this balancing point of, I think Einstein said, keep it as simple as possible, but no simpler. That's probably a nice maxim to work to. And then the other part about the process I think is really important is about keeping it personal, recognizing that each of you is very different. All of us are. All traders are different. If you read Market Wizards, it's a great way of getting the insight that there are many different people trading the markets in many different ways, different time frames, different markets, different styles, different ways of taking risk. So many variables down to the individual. So just recognizing the goal over time is to move from a learner who's probably got a very standardized way, you're learning from a trainer or a coach or a mentor to get you started, the basics. But as you progress over the course of your trading career, you want to be individualizing that and personalizing it. And that probably is key around, things like your risk tolerance, but also, it should be a reflection of your strengths and your interest. If you really love analyzing data and you love charts, then you might be drawn to technical analysis. But if you're somebody who loves reading the news and kind of, world events, you might be more drawn to the fundamentals. So, it's really important if you're going to excel or do the best job possible at trading, that it does reflect you and your own preferences and styles. But that process really is like the anchor point of your trading experience. The next topic I want to talk about is this idea of taking just right risk. And again, it's just one that it's probably seems kind of, I know that, Steve, and it almost seems too basic. But what I will say to you is I've just had so many conversations with traders who have come to me for coaching, again, often with anxiety or stress or feeling the pressure or nerves or fear, which is a classic one. And again, what they are is they're having an experience, which they're kind of saying is a psychological experience as such, so it's internal. But the experience itself is not the challenge. It's where's that experience coming from? What's the trigger for that? And in many cases, it is about how people are managing their risk. So this is just a nice framework that you can be reflecting on. If you're a person who finds yourself, worrying a lot about your positions and your P&L, and you get stressed and anxious a lot, then do some reflection on the risk you're taking in the markets. And this inverted U curve really is just showing the relationship between risk and performance, but more importantly is about balancing three component pieces. So when we think about how much risk should I take on this particular position, there are a few things to consider, including obviously the market, perhaps the volatility of the market, the product you're trading, but also you as a trader, your own risk tolerance, your capital that you've got available. So these are kind of core factors we've got to consider, and to a degree they're going to determine, along with your strategy and your capital management plan and your risk management plan, how much that position probably should be. But I would also urge you to think about this inverted U, such that any position you take in the market, so any number of contracts traded, the size that you take, could be, if you're on the right hand side, too high for you at that moment with that product. And when the risk is too high, it often manifests as fear and anxiety and worry and stress. So you've got this position, you get into the market, and immediately, if it jumps on side, you get the excitement, that the money's flashing in front of you, and you think, oh, I must take that quickly. Or if it goes against you, that immediately the heart, you feel it in the belly, the body reacts. You can feel the stress and the pressure building, and there's that panic as it moves against you. And if you're getting those kind of experiences in your trading, they're good feedback mechanisms, because it might be saying your trading sizes are too big in that situation. On the flip side, though, it is possible that you could be traders can find themselves trading too small. So the position is so small they don't really pay enough attention to it. They can get a bit complacent. Trade moves against me, comes down to my stop loss, but you know what? It's only small. The loss is okay. I can take that. It's fine, and I allow it to go further down. So now I'm not really following my rules. I'm being ill-disciplined just because the size doesn't feel relevant or impactful enough. And of course, in the middle is this sweet spot. But the sweet spot is not just about the size and how it feels. It's also about this. When a market opportunity sets up, of course, you want to try and optimize the opportunity. So we want the sizing to reflect that. But likewise, we want to balance it with quality of execution. If we go too far to the right or too far to the left, then suddenly our execution starts to decline. The quality of our execution starts to decline. And we also need to think about, particularly on the right-hand side, if we go too far on the right, if this trade loses, so if I'm wrong and the trade loses and I have to take the loss, what's my ability to recover like? Because if you take a big loss and you go into a long period of recovery, you've got to suffer sort of the traumatic impact of that psychologically, but you're also missing out on market opportunity while you're recovering. So when we're kind of taking our positions, we should be thinking about, yes, we want to maximize the opportunity, but we need to balance that with, but will this size allow me to still execute my trading strategy effectively? And if I'm wrong and I lose money, will I be able to recover? And again, some people might be able to put that into a, an algorithm or into a spreadsheet, but quite often there's a little bit of judgment and feel about what that would be. And it's often a combination of two things. It's, you're having a sizing strategy, which you can kind of use as your guide, and there might be some flexing around that individually based on market conditions and the unique situation that you're facing at that moment in time. So, just have a think about, your own position sizing and risk taking and the experience of your trading. And if you're in doubt, always just dial down the risk a little bit and just see if it makes a difference. I mean, the goal, as we're going to talk about next, in trading for me is being in a position to be able to make good trading decisions. So I want you to think about, and you can go back maybe this year, go back into next year if it's easier, but just think, in the last sort of, 3 to 6 months, the best trading decision that you've made. Just see if you can bring that to mind. And then see if you can think about the worst trading decision you've made. And just bring that to mind. And now I want you to think about that best trading decision that you made. And just think about whether that trade was a winner or a loser. And think about your worst trading decision that you made, and was that trade a winner or a loser? Now, my guess would be this: the majority, and I'm going to go for 90% of people or more, when you thought about your best decision that you've made, trading decision you've made, it was also a winning trade. And that when you thought about your worst decision you've ever made, it was also a losing trade. And that very few of you would have had a best decision that was a loser and a worst decision that was a winner. And that's perfectly normal. That's why I was able to kind of make a relatively educated guess, because again, we're all human, so we all think in quite similar ways. But what it shows is this outcome bias, that we tend to judge the quality of our decisions based on the outcomes rather than on the process we follow to make the decision. And what I want you to be thinking about, and this is for me is probably one of the most importantly fundamental shifts to make in trading, is to really start to think about the goal not being about so much making money, but making good trading decisions, kind of developing that process, getting the risk management right, and then really executing as well as you can. And then you can get the feedback on that and you can improve that process over time. Now, here's a nice, simple little tool that you can use to really make this very practical. If we think about trading decisions as falling into one of 4 quadrants, if you follow your process, so let's assume you've got a trading process and you follow that process and it wins quadrant 1. People very happy if they get a quadrant 1 trade. However, you might follow your process and that trade might lose. And that is going to happen. Some of my best traders have a win rate, of a hit rate of about 45 to 50%. So most of the most successful traders I'm working with are right about half of the time. Now, if they follow their process, then it means that half the time they're going to be in quadrant 2. It's going to be a losing trade, but they did all the right things. This, again, is a reflection of the probabilistic nature of trading and the role that luck and randomness plays in the markets. However, you might not follow your trading rules. You might not follow your process. You might trade too big, or you might trade too small. You might not be patient, so you get into the market too early. You might get to your stop loss, but let the trade go through that. You might get out of your winning trade too soon. And you do that knowingly. So you know that you're doing it. And when you do that, of course, you could still win. So that trade could still make money. And of course, you could do the wrong things and the trade could lose. So we've got these 4 different outcomes. Now, ideally, we want to be looking to be in that top shelf as such, getting 1s and 2s. 3s are dangerous because 3 is, you did the wrong thing, but you got rewarded for it. And one of the traders I'm working with at the moment, he's very good at recognizing it, and gets quite hard on himself, gets really disappointed with himself when he gets a quadrant 3 trade, because he's determined not to allow himself to feel good if he didn't follow his process. So his kind of whole mindset is, the goal is to follow the process, do the right things, do that consistently as much as is possible. 3 is like, it's like a child being naughty and being given extra pocket money. You get rewarded for the wrong thing. 4, of course, you did the wrong things and you get punished. The danger with the quadrant 4 trade is quite often when you break your process and then things start going wrong, you end up with, big positions moving against you. They become quite large. The losses are big and they have a significant impact. But the way to avoid quadrant 4 trades is to also avoid quadrant 3 trades, which is to really focus on the 1s and the 2s. So what you could do, if you keep a trading journal or a trading log, is you could, and just try this for a week or 2, just next to each trade, give it a 1, 2, 3, or a 4. And I was doing some work with some retail traders on a course last year. And what we talked about actually was that just having that in the back of your mind when you're going into a trade, thinking about, if I make this trade now, and as I'm going through it, am I giving myself the best chance of this trade being a 1 or a 2, or am I also allowing it to be a 3 or a 4? But just being kind of really aware of this idea about making good decisions. And the research is pretty clear that when you become more focused on your decision making and making good decisions, 2 key things happen. One is you will reduce the impact of emotions and stress in your decision making, so you'll dial that down. And you'll also actually, and importantly, reduce the impact of some of the cognitive biases which can interfere with your trading decisions and your trading returns. So just really focusing on making good decisions. And actually, if we go back to the mastery mindset, the long-term goal is to get better at making good trading decisions. That's kind of the long-term goal. So all sounds good. We've got a process. We're coming in with the learning mindset. We develop a robust trading process. We focus on getting our risk management right and kind of being in the sweet spot, the just right zone. And we focus on making good decisions. So far, we're doing all the right things psychologically, and we're setting ourselves up to be more successful than not. Then there's a reality check, which is this. So just think about these situations. Imagine a time when you were in a trade and it's moving towards your stop loss. And just think about how it feels as you see the price moving down towards your stop loss, and you've got to take the trade, take the loss, and then it happens and you have to take that loss. And then think about what it's like when you're in a winning trade. You're on side, you're making money, it's moving towards, your profit target. Maybe it's a bit, there's a bit of momentum early on. You think you're going to get there, market retraces. Ooh, how does that feel? You were here making the money, and now suddenly the market's retracing. You see your P&L on that trade reducing. Then maybe it starts to go up again, but then maybe it plateaus. And just think about, kind of how that can feel. Or, a trade you've been waiting for, the setup. You can feel it's going to happen. You're waiting. You're trying to be patient. You're waiting, but you kind of this urge, this impulse to want to get into the market. And what's happening in these situations often is this kind of sensation of discomfort. And it's really important to recognize that that's a normal part of the trading experience. Is there will be situations that are going to be uncomfortable. What's interesting is, what do we do when we become aware of that discomfort? And the challenge here is that part of our human condition actually is to stay comfortable. So when we start to notice this discomfort, what we want to do internally is to try and get rid of that. So, if I'm in a situation where I'm coming towards my stop loss and taking that loss is going to be uncomfortable, if I don't take the loss and I let the market just carry on, in the short term, my discomfort goes away. I'm not taking the loss. I'm still in an open position. If I'm in that winning trade, I'm not quite sure, is it going to go up or not? In the moment, if I just take the money, I see the return, I've made some money on that trade, and it feels comfortable. I haven't got the anxiety of, will it go up, will it come back? I take myself out of the pain. If the market's doing nothing and I'm sitting there watching the market and I'm getting bored, boredom can be uncomfortable. I'll just place a trade. And now suddenly I feel better. The discomfort's gone away. So can you see how, trading behaviors, which often, if you think about the gap, a lot of those behaviors, where are they coming from? They're coming from this need to be comfortable. And what we're doing is we are seeking comfort in the short term, so avoiding discomfort in the short term, but the payoff is we're also perhaps impacting on our long-term gains. So the goal is to be able to be in a position where we can accept and learn to be comfortable with that short-term discomfort so that we can get the long-term gains. And I was doing some work with a hedge fund manager last year, very successful, has been. And the way we've got him to the next level is to really think about this willingness to be uncomfortable, to stay in the winning trades for longer, to be more patient. But it does mean being uncomfortable. I mean, losing is uncomfortable. Feeling regret is uncomfortable. Being wrong is uncomfortable. Making mistakes can be uncomfortable. Uncertainty, ambiguity, missing out can be really uncomfortable. And our attempts to avoid feeling uncomfortable will be the very same behaviors that for many of you will be reducing your market returns. So we need to do a mindset shift. We've got to think differently. We've got to go, right, well, discomfort is a part of trading, not something to be avoided, but something to get good at. And that starts with a mindset shift, being aware that it's normal, being willing to be uncomfortable are the two first steps to doing that. And then what we'll talk about in a moment is how we can manage our emotions and what shows up when it's uncomfortable. So kind of, a few tools for getting good at it. But it's really important. And you can see the examples there at the bottom in the boxes, not pulling the trigger, getting out of trades early. There's this short-term, long-term playoff. So, when you're in a decision making, in a decision moment in your trading, you can be thinking, okay, if I'm making this decision now, what is it doing for me? And if I'm just making that decision to feel comfortable and nothing else alone, then maybe we should be looking not to do that action, but to do whatever the opposite might be in that particular situation itself. So, being willing to be uncomfortable. Now, of course, some of that discomfort comes from our emotions. So what I want you to do is have a think. If you've been trading actively, maybe do it for the last week or two. If you trade less frequently, go back maybe over the course of the year and just think about some of the emotions you've experienced in your trading over the last few weeks and months. If you've got a pen and paper, maybe just write a few of them down. And for those emotions, think about maybe when they arose, kind of what the situation was. And think about what the impact was. So when you were aware of the feeling, fear, worry, anxiety, stress, joy, happiness, satisfaction, overconfidence, confidence, conviction, whatever it might be, what was the emotion? What was the impact? And how did you manage it? Because these are really important questions, man, because this is often where we might get this discomfort from, is the feelings inside of us. I mean, emotions are physiological sensations in the body that we've given labels to. So we often feeling it in the body. Now, again, what's interesting with emotions is a lot of traders I work with, and this was definitely true in 05, 06, probably up to 2010 for probably the majority of clients, maybe slightly lower now, but still a large number of traders are trying to get to a situation where they can trade without emotion. So just think, is that me? Am I a trader who's trying to trade without emotion? And if you are, I just want to remind you that you're human. And that's the one thing, as traders we've got in common is we're all humans. And what do humans have in common? We have emotions. And actually, interestingly, if you look at the neuroscience research, the humans that have damage or lesions to their emotional circuitry in the brain actually find it hard to make decisions. Emotions enable us to process information, but they importantly give us that kind of a lift. They give us the energy to act on the information. So logic alone can kind of solve the problem, but it doesn't give you the energy to actually act out the solution. So emotions themselves are not the problem in our trading. At the extremes, they can be unhelpful. We need to learn how to manage them. But in general, emotions are part of the way the brain is wired to make a decision. In fact, we are feeling before we are thinking. So when you're making a decision, you've already had a feeling before you have that thought. Now, one piece of interesting, I guess, an insight or some research from the neuroscience I want to share with you is just recognizing that one of the key reasons why we have emotions is that emotions are data. So trading is a risk reward activity. And there are two particular emotions which show up for those two particular features. The risk emotion is fear, and the reward emotion is excitement. So we get a sense of fear, or the emotion of fear, when there's some sensing of some kind of risk, and we feel excitement when there's some sensing of reward. So even just being aware of that is important. So when you're feeling an emotion, what you could be asking yourself is, or be aware of the emotion, put it into words. Or I notice I'm feeling some fear, or be specific. I'm noticing I'm feeling a fear of loss. And you could ask yourself, well, what's the message here? Or what purpose is that trying to serve for me? Because there is like a data or information stream that we can utilize. But the one thing I want to really try and stress is the goal should not be to eliminate or trade without your emotions, unless you want to go automated. If you want to have an algorithm, that's different. But if you want to be a human trader, then we need to recognize emotions are part of it. We want to manage them. We want to work with them. But your attempts to eliminate them might be resulting in the very behaviors that actually are getting in your way. So again, we've got to be thinking differently. So we've talked a bit about, mastery mindset. We've got to have the right mindset. We want to be learning, getting better, trying to be the best trader we can be, trading at our best. We want to develop this robust trading process. We need to manage our risk. We want to focus on making good trading decisions. We know it's going to be uncomfortable, so we want to be willing to open up to the discomfort, be happy to be uncomfortable, get good at the discomfort. That is the goal. Part of that is learning to work with our emotions. Let's see them as data, change our mindset, change our thinking, become less reactive to them. I also want you to recognize, and this is again a bit of thinking differently, that your body, the state of your body, your levels of stress and fatigue, your physiology and your biology is impacting your decision making and your risk taking. And on the screen there, just to quickly give you some context, this is two different trading clients I had hooked up to some monitors. Red bars are stress, green bars are recovery, and blue bars are physical activity. And I've done quite a lot of work over the last 5 or 6 years, particularly on monitoring trader physiology and looking at the impact of their trading on their body and of their body on their trading. There's been some quite good research done in the worlds of trading and investing on the role of biology and physiology, and it impacts our risk preferences. So when we're stressed, particularly if we've got chronic stress, kind of that long-term ongoing stress, people become more risk averse, and fatigue has the same impact. When traders are on winning runs, it increases their risk-seeking preference fueled by testosterone. So there's hormonal changes, there's changes in our neurochemicals, there's changing in our physiology, all of which at any given moment sway us one way or another in terms of our decisions and our risk taking. Now, this is important because one thing I want you to recognize, or two things. One is many of you might be working a full working day and then coming to trading later in the evening, or trying to squeeze it in early in the morning by kind of getting up early. So just be aware of what your physical state is and the fact it may be having an impact on your trading. But also just recognizing the importance of basic factors like, sleeping well, being physically active, trying to, take some breaks, recover well, eat well, hydrate. Basic practices which just kind of keep the body system, the body-brain system optimized. The brain is 2% of your body weight. It's about 20 to 25% of your energy consumption. And when the body is, dehydrated and hasn't had enough sleep and is tired and fatigued, then it's hard for the brain to function. And it goes into this mode really of kind of cognitive ease, just making quick, simple, easy decisions, trying to avoid risk, trying to avoid making decisions sometimes, which isn't useful for us when we're trying to engage in the markets, process information, and trade at our best. So just do recognize the role of your physical state and how it's impacting your trading decisions and risk taking. So we've covered a broad range of topics. We started with this idea of mastery mindset, which I think is fundamental. The goal is to become a better trader. Mark Douglas talks about, I think it's in Trading the Zone, but there's a future projection of yourself to grow into, like a future trader you that you're trying to become and evolve into. Trading process is the anchor point. It should be the core focus. The more robust your process is, the less likely you are to suffer from psychological distresses in your trading. If you think about a funnel, if you kind of have a really good process and you're doing all the right things, you're going to have to manage some psychological interference, but it's going to be less than if you're not doing the right things and you're minimizing the work at the front end. You're going to have more to deal with at the back end when you're engaging in a market. So that process is key. Preparation, execution, evaluation, and improvement. Risk-taking. Risk-taking has a huge impact on the quality of your execution, so it must be a central focus. The goal is to make good decisions, and decision-making and risk-taking are very closely aligned, but we want to focus on making good decisions, getting some ones and twos from our 4 quadrants. It's going to be uncomfortable. You're going to get discomfort in your trading. The goal is not to avoid it. It is not bad. You are not bad. It's part of the experience. We want to get good at being uncomfortable. That's the goal. And they've shown that in the research. Did a study in the US, and what they found was this is top performing traders, and they found they still got discomfort from the markets in the same situations as you do and I did, but they've just got better at dealing with it over the years. They've kind of find their ways to manage it. See if you can be more open to the idea of emotions as data and messengers, being less quick to try to avoid them or suppress them or not feel them. Just notice them. What are they telling you? Can you add it into as an additional source of information? Because that's why they're there, they're data. And just be aware again, this of your physical state, and just making sure as best as you can that you're physically ready to face the markets and to engage, because your brain is embodied, it's housed inside that body. And this is my, I think my simple framework for trading is to be a great trader, you have to think differently, because if we just go into uncertainty and we try and take risk with our kind of standard human condition, then it doesn't end well for most people. So we need to be doing things differently. We need to make better decisions, but making better decisions starts with thinking differently. We think differently, we make better decisions, and then as a result of doing that, performance can improve over time. And that's just a nice framework to be thinking about. Now, in a moment, I'm going to go into some Q&A, which will be great to get some questions. Maybe be thinking already, if you've got any questions about what we've covered today or other questions on the trading psychology topics that are interesting for you, get those primed up, get them ready, and we can do some Q&A in a moment. But I want to spend just a minute or two just talking about this opportunity. It's something I do very, very infrequently, but and it's mainly just been down actually to lockdown and being at home more than I would normally be. But we ran a program last year, and XDB were a partner in this, where I enabled retail traders, private traders, people trading from home, to work with me in much the same way as I would do with my institutional clients on developing their trading psychology, working on mindset and mental skills. And it's an 8-week program. So we do a 90-minute session each week. It's 7 p.m. UK time. I deliver them live, but they're also recorded in case you can't make it or you want to listen again. We do some live Q&A, so we talk about the content. We do some exercises live in the session. We discuss, we share ideas. Then after the session, I set some follow-up activities, which are optional, but often people like to do those. We have some mental training exercises. We have a journal that's kept. And then we get back into the next session and we kind of talk about what we've been doing. And then in between sessions, people can email me and ask about, how to implement the work or any challenges they're having. And that rolls on for the 8 weeks. And we did it last year for the first time for a number of years. And people seem to really like it and benefit from that. So I'm going to run the same thing again this year. We're still in lockdown. I'm still not traveling. So it's a great time to be able to do a little bit more for the retail community. So the course starts 15th of April. And if that's of interest to you, then you can contact your XDB account manager, and they can give you more details and also see if you'd like to be a part of that course. Great. What I'd like to do really is spend the rest of the session, we can put on to Q&A. So Sal, if you're still there, I don't know what's the easiest way to do this. Maybe if they can type them in somewhere and you can relay them to me. But if you've got any questions you'd like to ask on what we've covered today or just the topic in general, feel free to do that, and I'll do my best to give you some helpful answers. Okay, great. I've just got some questions coming in now, so I can take these. Just bear with me. Okay, so this is from Magda. What's the best way to avoid the feeling of FOMO? So FOMO being fear of missing out. So again, what I'm going to say here, Magda, which is really important, is FOMO is a part of our human condition. We get it in many different situations. We experience it in trading, and we get it obviously in life in general. So it's a part of us. Now, there's a couple of things we can do when we're looking at managing ourselves in trading. There are some things that we can do to prevent or to reduce what's happening to us, and then we have to kind of work out how we actually manage it. So if we think about at the mindset level, if I have a mindset where I believe that there are multiple opportunities in the market, that I don't need to get on all those opportunities, and that over the course of the year there'll be sufficient opportunity for me to make the P&L or achieve what I want to achieve. If I have that mindset, that will reduce my experience of the fear of missing out, as opposed to if I believe that I have to get on every single trading opportunity and maximize it. If I have that mindset, then that is going to create a greater level of tension in me. So the fear of missing out will be amplified. So one thing that's important is to think about our beliefs about market opportunity and how much. Now, I have done some research on this many years ago, and I asked a lot of traders, professional traders, what percentage of opportunities that occur during the course of the year do you think you need to capture in order to make that, as we call it, the budget or the P&L for the year? And most of them were around sort of 50 to 55, possibly 60%, but the majority were around about half. So institutional traders were telling me they could miss half of the trading opportunities that showed up and actually still, do well for that year. So I think that's one thing to do, is to think about, what's my mindset around market opportunity? What do I believe around the number of opportunities and what I need to capture? The second part is to recognize that fear of missing out still shows up. And actually, it's not about avoiding it. Again, this is one thing that in my work, I've got probably strong feelings about, is that when we try to avoid things, we can often create more problems by trying to avoid the fear of missing out than by having the fear of missing out. The fear of missing out is a normal feeling to have, and the way that we can manage it is to try and reduce it through mindset. We can also reduce it, or we can manage it in the moment by acknowledging that we're having that feeling. So often we think that we shouldn't have the feeling, but the goal in trading actually is to be aware of what you're feeling. And as you become aware of the feeling, and what it does is gives you a bit of distance from it, and it reduces that intensity and that urge to action. So the goal is to be able to have the fear of missing out and to notice the feeling, but not to act on the feeling. So the feeling itself isn't what costs you any money. It's when you act on the fear of missing out that costs money. So it's about being aware, noticing the feeling and accepting and allowing the feeling and noticing it. Notice in the language, I am noticing, I am having the feeling of the fear of missing out. And you could, if you wanted to, also think about, and why might that be? So, what might the message behind that be? And once we can start to put our feelings into words and bring an awareness to them, it shifts us significantly, and it will allow you to be more able to take the action that's appropriate in the situation. So mindset can help to reduce it a little bit, and then awareness and acceptance and noticing and acknowledging it can, in the moment, reduce you acting it out, which is the goal. The goal is to be able to have the emotion without the emotion having you. Reese, your question, what's the best strategy to handle emotion to optimize trading performance? So again, really, and again, ties into what I'm saying with Magda. My view, and obviously different people have different views, I can only give you my view, but my view is the best way to handle emotion is to be aware of the emotions you're having and to be able to put those emotions and feelings into words and to think about, the data, what the message or the purpose behind them might be. When I first started working in trading, having come from sports psychology, I was still probably in a zone where I was into maybe we're trying to control or reduce emotion. And just over the years, through training, through research, and through just working with thousands of traders, I've just realized that a lot of people spend a lot of time trying to control and get rid of emotions without success, and at the same time causing quite a lot of damage to their trading returns. So and the neuroscience now is pretty conclusive. Emotions are a key part of how we make decisions, and we're more effective if we can just learn to manage them. So if we're not aware of an emotion, if it's kind of unconscious as such, then it can have quite a lot of hold over us. But once we bring an awareness to it and we're able to notice it and label it, put it into words, I'm noticing, I'm feeling, whatever the emotion might be, it actually gives us that nice bit of space and an awareness that allows us to make more effective choices. And we might also, with that space, be able to think about, if we've got time, what the data behind that emotion might be. And I think skills like meditation and breathing type practices are very useful because they can train our ability to recognize signals in the body, what's called interoception, which is important for emotional regulation. And just this kind of mind body awareness and just the ability to even notice in real time, things like mindfulness, where we're able to notice what's happening to us in real time. If we can't notice the emotion as it's happening, then it has this kind of more of a hold over us. But if I'm able to notice that emotion in the moment as I'm having it, immediately it shifts my experience and my potential to make a better decision. Question from Alex. How about deeply rooted beliefs about money, and can they hinder the trading process? Yeah, great question, Alex. Thank you for asking. So our beliefs really are a bit like filters for experience. So, we've all got beliefs, and we pick them up very early in life, and quite often we don't even think about them. And so, we are perceiving the world around us, and this information is coming in, and part of that filtering process is our beliefs and our perceptions about the world, as you've said, about money, about trading, about markets, about success, about failure, about winning, about losing, about mistakes, all these things. So when we have an experience, our beliefs are a factor in how they play out. Now, there's different thoughts about how these play out and why they play out. But one of the things that I do with my clients is, and this is, let's work with your one about money, is we might identify a behavior in our trading which isn't useful. And so we see we're doing this behavior, and maybe it's in a certain situation. We might try and work out, well, if I'm doing this behavior, this consequence is coming from this situation, what might be going on here in the middle? And we might identify, in your case, as a kind of an unhelpful belief related to money. So it can definitely play out for people. I had a client many years ago when I first started working with traders who had come from a very working class family in the north of England, where his dad had worked long, hard hours. He'd come down to London, got a job. His son, who I was working with, come down to London, had a job as a trader on a very good salary, then has 2 or 3 years of really good trading and makes phenomenal sums of money. And there was this kind of real conflict between how he'd been brought up and kind of, you know, working long, working hard in kind of a very manual labor type role, and then his son who was working hard, but obviously sitting down in a comfortable office at a screen, not really sort of making anything as such, but earning obviously vast sums of money. And there was some conflict there, which we were able to resolve. But the key part with all beliefs is the first stage is recognizing them, that I've got this belief. And beliefs are not right or wrong. So, you know, when we look at a belief, we have to think about, in this context, is that belief helpful to me or not? So if I've got a belief about money, you know, there's that, you know, the old well-known belief, you know, money is the root of all evil. You know, if you hold that belief, or money, easy come, easy go. I had that from a client. You know, money's easy come, easy go. Guess what? In his trading, made some money, lost some money, made some money, lost some money. So these beliefs can play out, but it's much more. You've used the word deeply rooted, and what I would call them is how attached to that belief we are. So how strongly we believe that to be true. And I think once you are able to identify a belief, and then you can think about, well, where did that belief come from? Because we weren't born with it. You know, we've acquired it at some stage. And where did we get it from? You know, and we probably learned it from somebody. And is it useful to us anymore? I think once we start to recognize it's a belief that we have, that we've learned from someone, that may not be useful anymore, then we can begin to shake it up a little bit. And actually even just recognizing, here's a belief I've got about, again, we can get a little bit of distance, which is a very workable strategy for many people. And actually then what we need to do is, in essence, once we can kind of shake up the belief a little bit, is it frees us up to start taking action. And then as we start taking action, actually the new action can build a new set of beliefs that are useful for us. So one thing we can't do is unlearn. So there's not an unlearning process. So it's about, you know, reforming and learning some new helpful beliefs. So hopefully that's useful for you with that. Question from John. Personally, what's a good diversion strategy when you're feeling hard on revenge trading? Okay. So the question, John, for you to be thinking about is, what's the emotion I'm feeling that takes me into revenge trading? So that's the really key part, you know, because what revenge trading is essentially doing is often acting out some kind of emotional energy in an unhelpful way. And so again, you know, this is where it comes down to, let's say you've had a losing trade, a big losing trade, or maybe it's a sequence of losses, and then there'll be some feelings that are coming through, and maybe there's some thoughts. So it's kind of thoughts and feelings that are coming through, and often our attempts to either get rid of those feelings, not to feel them, or to try, or we act them out unconsciously, drive us into this unhelpful trading behavior, revenge trading, or we might get attached to a thought. So the thought might come into our mind, I need to get my money back. Now, when we say the thought, you know, in that way, I need to get my money back, for example, it feels like it's a fact, and it can create this urgency to act on the thought. And we need to recognize that, you know, these feelings are showing up, these thoughts are showing up. And again, the more we can be aware that these are thoughts and feelings that are showing up, and we can be aware of the feeling and we can be aware of the thinking. And this is what we do with my clients, is we train them to build up the awareness in real time of their thoughts and their feelings, such that they can be an observer of the experience. And when we are able to observe the experience but not be in it, it's like being above a river in a helicopter looking down at a river versus being in the flow of the river. So if we can train ourselves to be this observer and to notice the thought and to notice the feeling without the urgency or feeling this impulse to have to act on them or act them out, then we can reduce that revenge trading. But for many people, there is often a feeling that's showing up, and they're either act out that feeling because it's strong and it's impulsive, or they're trying not to feel something. It might be, you know, might be feeling bad or angry or frustrated. They don't want to feel that, so they take an action to try not to feel the anger or the frustration. And sometimes we need to allow ourselves to feel the emotion, because that's the relevant emotional response to the situation. We want to allow ourselves to feel it, but again, not to have to necessarily act it out. Question from Patrick. What about taking only small positions? It seems the easiest way to handle the feelings and avoid bad decisions. Again, Patrick, what I would say here is small is relative. So if we go back to that inverted U curve, for any given individual trader trading any different particular market product with levels of liquidity and volatility and so on, there's going to be a zone at the top of a position size which they're able to balance execution, opportunity, and recovery. If they trade too small, the danger can be that actually when positions are smaller than they want them to be, and I've had traders who've done this recently, is you can start to form bad habits quite easily because you don't pay enough attention, doesn't kind of focus us enough, and we get kind of overly complacent and under attentive. So it's about just right. That's what we're looking for. Now, for many traders, my thought would be perhaps in the newer to maybe novice retail traders, potentially dialing down the size a little bit would be helpful, because the tendency is that many traders trade too big, either through just lack of knowledge and awareness, or because they've got expectations about an amount of money they want to make or feel they should make based on the capital they've got available, which leads them to kind of be in that right-hand side of the curve, which isn't helpful. So it's always about checking in. If you're finding that you're not being disciplined in your trading, that you're never following your plans or your rules, one thing you can check is, how am I feeling at those different times? And if there's a lot of emotion showing up, risk and anxiety and stress and discomfort, just practice dialing down the risk. So, but I definitely agree. I think your sentiment is right about, being mindful of not taking risk that's too big. But again, it's all going to be relative. For some of my top level, high-end institutional clients, what is small for them would be phenomenally huge for most average retail traders. And likewise, I've got some retail clients I work with who trade huge positions relative to other retail traders. So it's a very much an individual factor. I think that might be the last question. Oh, that is it. Yep, good. That is the last question. That's it for today. So just want to say thank you to all of you for joining me. Hopefully you found some of the information there interesting and useful. I want to challenge you all to see if you can take at least one thing away from today's session that you can apply into your trading over the next few days or week or so. And if you, again, just a quick reminder about the course, if you're interested, obviously get in touch with everyone at XDB. Thank you to XDB for giving me the time to talk to you and work with you. Have a great rest of the day, and obviously all the best with your trading over the coming days, weeks, and months. Thanks very much.